Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com talks about the pounding crude has taken lately and what the prospects are for oil over the winter. Author of the revised book, When the Bubble Bursts, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, gives us the latest update on the Canadian real estate picture. He looks at how home equity lines of credit might prevent you from easily renewing your mortgage. Market historian Bob Hoye gives us his opinion on how the latest U.S. election results could impact the markets and gives us some perspective on how things have worked out in the past. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to This Week in Money, Ross.
Good to be with you, Jim.
Ross, is crude now crud?
Well, it's been leaking, and to the point, and this is actually, it's been a really interesting year, the way the oil market has moved. There was that false breakout at through $75 in the spring. Then, as it started to work its way very easily through supports, it's gained some good momentum, and we've now finished 10 consecutive days of downside action. Haven't seen that since back in 1984. Some say 1984. I take a look at my data and said it's even further back than that. This is following pretty much the pattern we'd hoped for. Inventories are high. You've got production increasing in the U.S. You've got the OPEC increasing its production. So seasonal low is probably between here and January, and the level to which we are now oversold would suggest that we're ready for a bounce. I think it's probably in the 5 to 10% variety, so that could be maybe anywhere from $3 to $6. But this doesn't look like it's the final low. When we've got the 10-year cycle that we look at, with lows in the fourth quarter of the 8th year, the break is usually 30% or more from the high, more like 35%. So our targeting is down into the mid to low 50s. And from there, things can get exciting on the upside, but I think we got to put in the low first. And if the weakness that we've got here does work its way through the next month or so, the opportunities on the stock should be quite good, because the seasonal pressure of selling for tax reasons when stocks are down will really come into play. So we'll be looking to put out some recommendations on specific stocks in the next 4 to 6 weeks for companies that are beaten down and have an opportunity to come back. You know, in particular, you look for ones in the oil service area in terms of the drillers who have really been beaten down, exploration side of things that don't have the production. Those ones should be some pretty good opportunities. So kind of looking forward to the next 4 to 6 weeks here.
Ross, on the stock markets, I'm calling this kind of a step-down correction where You have 2 or 3 days where the market's down, then it's up sharply, but it doesn't seem to get back to the high that it just established. Is this what we expect to see for the next while?
Yes, we've this thrashing process. It's just all part of this big consolidation we've had since the January high, actually, and the recovery bounce that we've had from some capitulation lows a week and a half ago were stronger than I thought they'd be. I thought we might get back maybe 50% of the break that we had. Most of the indices have now retraced about 60 to 65%, other than the semiconductors and the NASDAQ, which has been pretty rough here. But I would be looking for just more of this thrashing, as you say. Few days up, few days down. Overall, a test or a takeout of the lows that we put in during October, though, I think is a distinct possibility. At this point, there's just doesn't seem to be the impetus behind the market to push it. The earnings numbers are pretty much behind us. And yes, we do have a period of seasonal strength that would typically take you from here out into March. But there's a lot of overhead in this market, and the breadth is not that good. When you take a look at the number of stocks above their 50 or 200-day moving averages, the percentage of the AD line and how it's reacting, there isn't any solid fundamental or technical support that we can see just yet.
Going back to oil, do we expect to see a point where it's going to be a great opportunity to buy?
Oh, well, in my work, yes. If once we've put in this 10-year low, the typical upside action is over 200%. So, and that would be over a span normally of 2 years. So if we can get a big clean out in here, that I would just be so pleased with that. The technicals right now, the daily signals that we look for, I've got half a dozen things that have all fit into place literally in the second half of this week. Get a bounce and then another sell-off. And if we can get some weekly signals, some weekly buy signals, and to me that's an oversold signal. That's not a reversal to the upside. If we can get some good weekly signals in here as we move through November, December, and maybe into early January, because we had one cyclical low that was a January low historically. But if we can get that low in place, I think you could be talking about $100 oil at some point next year.
Ross, you're a longtime guest on This Week in Money, but your business, chartsandmarkets.com, relatively new. Can you tell us about it?
Well, what we're doing here is trying to provide the investors with an opportunity to view the technical side of the work that I do, which is looking for momentum plays and we like to try and catch turns. So at major tops and bottoms, we're looking for exhaustion points or capitulations. And then within the trends, we like to buy the dips. And so we look for a little, what we call a springboard, where you get a minor oversold and then you pop back to new highs. And in methodical trends, the investors can really get a nice return, at least an improvement on their returns by buying the dips in those kind of actions. And then we've got Bob Hoye out there who's doing the fundamental side of the equation. He's the big historical buff that loves to go back and look at the last hundreds of years worth of information and come up with some pretty good theories on it. And then Leventi Matti, who does our bond works once a week, a good breakdown on what's going on in the credit markets.
Ross, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Hilliard MacBeth next on This Week in Money.
Always consult your investment professional before making any investment decision.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm speaking with Hilliard MacBeth, author of the second version of When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard.
Nice to be talking to you again.
Under the current market conditions in Canada right now, do you see rising interest rates slowing down real estate sales more? Or conversely, will we see falling prices, and will that counter the rising interest rates and keep people still buying houses? I know it sounds complicated, but you see what I mean.
I see what you mean. Well, you know, in some markets, like Calgary, for example, it's possible that prices have come down to the point where the higher interest rates are not much of an obstacle, and people are jumping in, looking at the bargains. But there's also a psychological effect when people see prices dropping. They say, "Oh, gee, maybe we'll wait, and prices will drop even more." So even though maybe they can afford the monthly payments, they start to get, I guess, greedy in the opposite way. Greedy in the sense that, hey, maybe that $500,000 house will be $450 or $400 a couple of months from now. So. I guess what I'm trying to say is when the tide turns, everything changes, and that's kind of where so the old formula of when the markets are rising, and I remember when interest rates were 14%, people were still buying houses at 14% because house prices were going up at 20% per year. So it doesn't automatically work that one offsets the other. And I think in most markets there is a bit of an uptick in Toronto, but generally in most markets the feeling is very soft. And then of course you've got other things other than interest rates and house prices that affect and one of the biggest ones in Alberta anyway is the worry about employment, because certainly the recovery since the 2014 shock from the oil industry it's not that strong, and so people are still worried about, are they going to have a job in the future? And if they're worried about that, then they're not going to move even if they can't afford the payments. Now, I did talk to a mortgage broker yesterday, and I asked them how much more would interest rates have to rise before people start to get pushed out of the market because they can't qualify anymore. And the answer was, we're just about there now. So the rates posted in that kiosk were between 3.2% and 3.9%, depending on the term you select. So the representative was suggesting that the people can't handle much more of an interest rate, which is kind of crazy because rates are still at levels that are just absolutely mind-bogglingly low compared to the last 10, 20, 30 years.
Did people become so accustomed to low rates they couldn't imagine anything higher? And does that mean when they brought in the new stress test rules, they were absolutely right to do so?
Well, it's that saying has been overused in the housing market, but closing the barn door after the horses are out in the pasture is absolutely correct in this case. The stress tests and the changes they brought in were late, in the sense that virtually everybody that could fog a mirror had already borrowed as much money as they could possibly qualify for at the lowest possible rate. So it's very unfortunate, but now it's going to hurt the other way, because now they're tightening up on as the market is starting to soften. the effect of the tighter rules is starting to hit. It would have been much nicer if it had been like 3 or 4 years ago, before so many people got so heavily indebted. So it is a combination of higher rates, I guess, and the tougher rules. And the rules apparently are getting even tougher in some respects. So they're not finished tightening, even though they're late to the game. But I think they feel they have to do this in order to get things back into line.
As you said, too late. What about the foreign buyer tax, 20% in British Columbia and most major urban areas now? Was that really necessary considering that real estate around the world seems to be going a lot slower?
Yeah, I mean, that was a political thing to some degree, because people felt in that market, really it's the only market in Canada, I think, that people really felt strongly about this. The foreign buyers were pushing the prices to the level where the local people couldn't afford them. And they conveniently ignored the fact that there was an awful lot of local speculators doing the same thing. But I think that had an impact, but I think the even bigger impact is the crackdown in China on money fleeing that country, and also the fact in Canada, and it's now, I think we're getting up to 2 years now this fall, the anniversary of the change where Canada Revenue Agency, CRA, is going to require that every sale be reported to them, and then people have to justify whether they qualify for the exemption on taxes on the gain of the sale of the property. This is a new thing. We always had the exemption, but it was sort of on people's it was on the individual people to recognize whether they qualified or not, and they didn't have to file the form. Now they have to file the form. And I think a lot of the speculation in Vancouver and maybe Toronto and elsewhere too was based on being able to fly under the radar. Now people can't fly on the radar anymore. They've just quietly disappeared. But it isn't just Vancouver. News came out yesterday about Seattle, a huge slump in Seattle. Seattle replaced Vancouver as the third most popular destination after LA and San Francisco for people from Asia to buy houses in North America. And now there's a big slump happening in Seattle as well. So it would appear that it might be coming more from the internal rules in China, that they're cracking down on people taking money out of China to buy properties in North America.
Is a HELOC, a home equity line of credit, just another name for a second mortgage?
I think it is. When I first became aware of this idea of getting another loan behind your first mortgage, it was always called a second mortgage. And then one of the banks, I think it was the Scotia Bank, came out with this advertising slogan, which has been extremely successful, and it goes like this: "You're richer than you think." And what that means is, talking to people in the lending industry, that you can tap into the equity in your home. And so second mortgage, to me, always had a stigma about it, that you're kind of desperation and close to bankruptcy or something like that. Whereas home equity line of credit, which is the new dressed up version of it, sounds like a wise financial thing. You're tapping into the equity in your home, which is kind of sitting there doing nothing, and you're using it for some more productive purpose. Now, the fact that a lot of it didn't get used for productive purposes, it kind of gets swept under the rug, because you're really basically allowed to use the proceeds from the home equity line of credit for whatever you want. Unlike the first mortgage, where the lender insists that you use the first mortgage to buy a house. The second mortgage, I think most people use it for renovations. Some people use it to buy a second or a third home. Some older people use it to re-lend it out. They become their own little bank. They borrow at 3 or 4%, and they lend it out at 7 or 8% and make the spread. And then more people often, and maybe not so much now, but 2 or 3 years ago, they were using it to give their kids a down payment so they could buy a house. But it's all based on leverage. It's all based on the same asset, which is residential real estate. And it's all very dangerous, even though the marketing departments of the big lenders have made it sound sexy and come up with great slogans, it's actually pretty dangerous, because the old idea of you get to be 55 or 60, you pay off your mortgage, then you save, you work hopefully for a few more years, try and save up as much as you can, and then go into retirement has become very old-fashioned now. People breeze into retirements with mortgages and second mortgages or HELOCs, and I think it's very likely to end badly for a lot of people.
As interest rates continue to rise, are banks likely to require HELOC payments of principal plus interest instead of just payments of interest?
They might do that. They've done that in Australia. Now, Australia, they're not called HELOCs. They're called interest-only loans, and they're mostly for investor. But practically everybody in Australia is a real estate investor. And now they're converting a whole bunch of them, and there's a very large number of them, to require amortization. So when you go from interest-only, where all you have to do is pay the interest on the loan, you don't have to pay down the principal at all, to amortization, where you have to pay so much of the principal down, your payments go up quite sharply, and that could be a next step. I don't think we're there yet, but certainly that's probably not far off. In the meantime, the other thing that banks can do is they can stress test you for the, and this is the new thing that just came out the last couple of days. They can stress test you as if you had borrowed. So the way the line of credit works is you have this, say you've got $1 million home and you've got a $300,000 mortgage. They, apparently it's very standard now to give you a HELOC of, let's say, another $300,000. So you've got a total of $600,000 borrowing capacity. And a lot of people say, well, I don't want to tap that HELOC. I'm just going to let that capacity sit there. And, so they make their payments merrily on the mortgage. But then when they come up for renewal, the new thing that came out this week is that they're going to be tested as if they were making payments on the whole $600,000. And so this is going to be very devastating for people that, in bad example in this case, because there's still lots of equity in that home that's untapped. But I suspect lots of homes, especially if house prices have dropped 10 or 15%, and they have in lots of areas, they might be getting close to that limit. And then if they have to stress test as if they were amortizing the whole amount, they might not qualify for their home. So that would mean they probably would still be able to stay with the same lender and get a renewal, but they can't look around and try and shop around to a different lender that might have a better offering. So they become locked in that. And the other thing about HELOCs is, which might be a little bit different from a second mortgage, is the bank does have the, although I don't think they've used this capacity, but they could come to you and say, you know what, we're lowering your limit because house prices have gone down 30%. We're not willing to keep that amount of credit available to you. We're going to lower limit. There was an interesting thing that happened after the 2009 crisis in the U.S. It was mostly businesses, and almost every business has a line of credit. And it's very similar to home equity line of credit. It's just called a business line of credit. And the day after Lehman Brothers, or right around that time, a whole bunch of businesses in the U.S. maxed out their line of credit. They didn't need the money, but they knew that the bank is quite likely to come to them and say, you know what, we can't extend that line of credit to you anymore. If it's undrawn, they can lower it, but if it's been drawn down, then they can't come retroactively and say you can't borrow that money. So that's why the business people went ahead and borrowed the money even though they didn't need it yet.
We'll have more with Hilliard MacBeth when This Week in Money returns.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Hilliard MacBeth. Hilliard, what kind of numbers have we seen for real estate sales in October?
Well, I know in some of the reports I've seen, the amount of sales in Toronto now it picked up a little bit, but in Calgary, but when I say it picked up a little bit, it's like, say something was going along at 100 and then it dropped down to 30 and then it ticked up to 40. The headline would be, there's a 30% increase in sales from 30 to 33% increase in sales from 30 to 40, but it's still 60 below the 100 that it was at before. That's the kind of uptick that we've seen in places like Toronto. However, in Calgary, we're looking at multi-decade lows in sales, and it's quite scary. And the same in Vancouver, I think, too. So there's little upticks and downticks on a monthly basis, but we're bouncing along at very, very low levels. And of course that eventually starts to wear on prices because there's always a few people that desperately need to sell, or maybe it's in an estate and people want the beneficiaries of the estate want to get their hands on the money, and they're not as attached to a particular price. They just want to get the thing resolved. So they say to the realtor, just sell it for whatever you can get it. And then of course there's the lenders. Now in Alberta, I'm most familiar with in Alberta, even though we've been basically in a recession for 4 years now, the lenders have been very gentle and they haven't been aggressively pushing people to sell yet. But and maybe they won't. Maybe they'll continue to be fairly light touched. But if they do get aggressive, turn it over to the foreclosure agent and the realtor and just say sell it for whatever you can get, the lenders generally don't care. Like if it was a $600,000 house and they lent $500,000 and now it's worth $400,000 and they lose $100,000, they'd rather have it off their books than to hang on to it, hoping that it goes back up to $500,000. They've already written off the loan. They've already written down the loan by $100,000, and they just want to get rid of it. So that stage has not been reached yet. That would be the next stage in this cycle. It takes a long time, and it's generally the lenders that start pushing the people to sell. So what you get, we're in a stage where there's very few sales because obviously the people don't want to reduce their prices, and if they're not required to for some reason, they generally tend to hang on to their anchor price, as I call it, rather than lower the price to the price that would actually be required to make the thing sell. And that period can last for quite a long time. It can last for, I know in the U.S. in 08-09, the banks were very, very slow to force foreclosure sales. And the average length of time people could live in their houses they stopped paying their payments, they stopped paying their taxes, they stopped paying anything, but they stayed in the house. They didn't move out. And I read at the time that the average length of time was around 2 years. So they were way better off. They weren't making their mortgage payments anymore. They weren't making their tax payments anymore. They weren't paying their insurance anymore. They were probably saving $1,000 to $2,000 a month. They weren't paying rent, and they got to live free for a couple of years. But eventually, of course, the system caught up to them.
Is the 2019 spring market likely to be a buyer's market with higher interest rates and fewer sales?
I think so. I think it's hard. You'd have to go and do a lot of research, which I haven't done, on the latest in the month to month, but just reading generally what's going on in the system. Rates are definitely rising. the rules are tightening. The number of young people that could qualify to buy that first house is shrinking, and so the inventory that's on the market now is likely to sit there through the winter. Winter's generally a slow time anyway, and then when the spring comes, we'll see if the buyers come back. But if the foreign buyers kind of disappeared, and the first-time buyer is struggling to qualify, certainly that conversation I had with that mortgage broker yesterday indicated that by next spring, the first-time buyer isn't going to be in any better shape. It's going to probably be in worse shape because the rates will have risen. There's at least 2 more Federal Reserve rate hikes coming by next spring, and possibly 2 or 3 more in the Bank of Canada as well. So mortgage rates are likely to be a little bit higher next spring rather than lower. And if people are already struggling to qualify, then it's not going to be any better next spring, unless we got a real rebound in the economy in Canada. But we don't see that. In fact, if anything, the situation in Alberta is getting worse because of the oil glut that's developed here, with a lack of outlet to sell it to the U.S. or elsewhere. So prices for the Alberta Select oil, Western Canada Select it's called, are down to ridiculously low prices like $20 when the world price is $62. There's a $42 discount. So that's not going to help real estate in Alberta, and probably will actually affect the rest of Canada a little bit too. So I wouldn't expect, unless something really surprising happens, that next spring is going to be any better than today.
Is it becoming tougher to qualify for a mortgage?
I think so. Yeah, I think I think the one loophole that still existed and still does to a degree exist is if you have a 20% down payment. But the stress test, this was the big change that came in a while ago, probably now about 10 months ago now, where they were qualifying people as if they were had less than 20% down payment, even when they did have a 20% down payment. The banks were required to apply the stress test to those people. And that was the big tightening that happened about 10 months ago. But I do hear anecdotally, and there is evidence of this, that the private lending market is just booming. So as the banks and the credit unions and all the other people have to follow these new tighter rules, the private lending market, which is just wealthy people, offering loans through mortgage investment corps, that sort of thing. Even just through the lawyer's office. I talked to one lawyer who said he's got offers every day of people that were willing to lend money, but they're going to want 7, 8, 9% for their loans, not 3 or 4% like the banks. So at 7 or 8 or 9%, there's still money available without any qualifying rules applied. But how much longer that'll last, I don't know. And of course, that becomes problematic in terms of that's a lot of interest to pay. So yeah, it's definitely getting tougher, and it's probably going to continue to get tougher until the next recession. We're now more than 9 years off of the last recession, and in Canada, the last recession was quite mild. So the next recession will bring interest rates down again, house prices down, and the cycle will reset, and affordability will return. But we're not there yet.
We'll have more with Hilliard MacBeth when we come back with more This Week in Money.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold discovery property located in the prolific Juno Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, people from mainland China, of course, have been buying up real estate around the planet. But now with markets declining, are there signs that those foreign buyers are now trying to sell and keep whatever money they invested?
Yeah, I haven't heard too much about them trying to sell, but I sure have heard that they are not as plentiful. And you can look at like West Van as a proxy for the foreign buyer, and the houses sitting there above $1.5-2 million. There's just dozens and dozens of houses, and hundreds of houses actually for sale above $1.5 million in West Van, North Van, and they're just sitting in. Not that long ago, probably 2015, early part of 2016, those houses would have been snapped up at $2 or $3 million by foreign buyers, and then they're just not. They're not being snapped up anymore. So, and obviously, if the foreign buyers who bought before that turn around and try and sell, it's just going to make the problem worse. I did look at a few of the houses there. There's 80 houses for sale over $7.9 million, and almost all of them are brand new, so they were built on spec. So those houses they're not probably owned by foreign buyers yet, because they haven't been owned by anybody yet. Somebody tore down a property, then built probably a beautiful view of the ocean and everything. But the problem with that business model is there's so few people that have $8 million and more to buy a house. It's just we have the same thing in Edmonton, where I live, in Calgary. You go into the $1.5-2 million and up range, and there's just hundreds of houses sitting, and the few people that can afford to buy those houses, those houses in that price range, they already own one, or in fact usually 2 or 3 properties themselves, so they don't really need to buy another one. And if they wanted to switch from what they have now to what's on offer, it's difficult, because then they'd have to sell a $1 or $2 or $3 million property to buy, and the market has really slowed down at that level now. For a while, the last few months, the market in the lower priced range, 400 to 800, let's say, has been pretty active, especially in the condos. But even that's starting to slow down now too. So it's getting tougher and tougher for people to find buyers for those properties. And I don't know what will happen to the foreign buyer who gets stuck with one of those properties. A lot of it's more of a Vancouver phenomenon, but we do have it a bit in Alberta too. A lot of those houses just sit empty, and it's a mystery to me. I don't know how the owners of those properties will react to a prolonged slump. I'm pretty sure in China, if they're from China, most of them probably are, there's an unwritten pact between the government and the real estate investor that the government is responsible for making sure the prices never go down. Of course, we don't have that in Canada. But the foreign investors may not realize that, so there'll be quite a rude awakening to them if they find out that the government doesn't step in and bail them out when prices go down. At least I hope the government doesn't step in and bail them out. I don't think politically that would be, well, I'm not sure that it would be possible, but politically it certainly would not be well received. I think a lot of people would be pretty upset if the government tried to do that.
In its first year of having a vacant home tax, the city of Vancouver collected $30 million. Was that unexpected?
That's a pretty high number. I think it's 0.5%. They kept changing the rules, but I gather that the latest is it's 0.5%. So that's a lot of empty homes. And there are fairly easy ways around it. So I don't know that the amount's going to be going up and up and up. Pretty sure the city hasn't, the province hasn't sort of found everybody that they could collect taxes from, but also just as fast as that, people are going to figure out ways to get around it by renting it out or on a long-term lease. And then, talked to one investor, they rent it out on a long-term lease, but they tell the people that rented it from them, you have to clear out every summer for 3 months because we're coming. So that's the agreement they have. So it works. And that way they avoid the tax. But the easier way, that's kind of complex and complicated, and, it's going to get messy sooner or later. But
Well, I believe that was the intent. Instead of having homes just sitting there empty, have people in them at least for part of the year and help alleviate Vancouver's rental shortage.
Exactly. And some of the wealthier investors, like in this case I'm talking about was actually Victoria, they don't really need a huge amount of rent. They just need somebody living there to avoid the tax. And so it's a good deal for both of them. And if it's a young couple that's renting the house for the year and then they're told they have to clear out for July and August, they can go on a holiday or go and live in a motel or something. I don't know. They can do anything. It would work. And that way at least there's somebody in it. But but a lot of people in Alberta, I think, I hear anecdotally from people almost daily that are saying that a lot of the people that own these properties are thinking about selling because first of all, they weren't using the property enough to really justify owning it anyway. Secondly, house prices are not rising anymore. And then, so those two reasons are independent of the tax. And then on top of that comes this tax. So that's kind of like the straw that broke the camel's back. And probably they were thinking about selling anyway. And now this is just enough to tip them over the edge to decide to get out of it. And of course, the oil wealth in Alberta is not flowing like it was before. So maybe they're going to need the money too. So there's 4 reasons why the Alberta real estate investor, who has been a big part of the real estate market in BC, especially in Kelowna and interior BC, but also in Victoria and other places. If that money dries up at the same time that the Asian buyer dries up, that'll be a really challenging time for BC real estate.
How far do you think real estate in BC would have to fall before people say, hey, that's affordable, I can buy it?
Well, it seems like Vancouver real estate's always been more expensive than the rest of Canada, and but it has had dips in the past, and certainly 30-40% it's happened in the 80s, and it may have happened again in the 90s. I'm not 100% sure about that. But if you look at the national numbers, to get back to the trend line that was in place before this bubble started to form in about 2003, 2004, it would require a 40 to 50% correction. And the correction required in Vancouver is probably even bigger than that. So those numbers are just mind-boggling. So that $3 million house in West Van probably has to come down to less than $1.5 million to get back to where it was, say, in 1998 or 1999. And that for a few people that won't bother them. They're older. They paid off the mortgage long ago, and they never really believed that it was real wealth anyway. And they didn't take out a HELOC and borrow against it. So what do they care? But for the people that bought in, say, the period after 2009, 2010, 2012, 13, that's going to be very painful for them, especially if there's a lot of borrowed money. And I think there's more and more of those people, and fewer of the older people who paid off their home long ago and don't really care if it drops from $3 million down to $1.5 million. I mean, their kids might care because it's a lot less money to inherit, right? But it's unfortunate, but that's what happens after a bubble that's fueled by a belief that house prices always go up, they never go down. That's been the belief. And secondly, by lenders who are very, very willing to create money out of thin air, which is what happens when they make a loan to buy real estate property. And it's not just Canada, it's all over the world, as I found out in September when I presented at the conference in Toronto. People came up to me afterwards from Australia, New Zealand, Denmark, Sweden. It's happening all over the world. And I don't know how. There's no way we can get out of it without a fairly large number of people experience quite a bit of pain in terms of the amount of debt that they owe.
Hilliard, the second version of your book, When the Bubble Burst, Surviving the Canadian Real Estate Crash, how's it doing, and where can people get it?
Well, it's doing really well. You can get it at all the bookstores and on Amazon.ca and Amazon.com. The only warning, just for people, if they're looking, make sure you get the second edition. It's got red coloring on the front of it. I think it's selling quite well. There was a bunch of copies available when I presented at the conference this September in Toronto, and they all disappeared within about half an hour at the beginning of the conference. So I was quite and it must have been the topic when the bubble burst, because they wouldn't have known me necessarily, but they were interested in the topic. And I would say that's quite a big change from 3 years ago when the first edition came out. So it's a topic that people are starting to think about and to zero in on. So we'll see where it all goes, but hopefully in the future we'll find out ways to prevent these bubbles from forming in the first place.
Hilliard, thank you so much for being on This Week in Money.
Thanks, Jim.
I've been speaking with Hilliard MacBeth, his website, macbethgroup.com. Coming up, Bob Hoye, next on This Week in Money.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
I'm Kelly Jennings, CEO of Powerband Solutions. Powerband is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. Powerband Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWBF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Looking like some fascinating things going on out there.
Coming out of the U.S. midterm elections with the Democrats now controlling Congress, the Republicans still in control of the Senate, is that going to change the economic policies in the U.S., and should people be worried about it?
Well, the tax cuts through Trump and the drive to establish a pro-business administration, that's locked in. And but what it will be is just extremely nasty politics on the part of the Democrats, who have become very radical, to say the least. But there are times, when I'm sort of thinking here, you can have nasty markets due to natural forces, like they always follow speculative, sensational speculation, which we have had. And also, as you know, we were looking for the probability of liquidity problems in the fall, which we're getting. In some cases, some important stocks have been down 50%, but it hasn't really hit the wide sweep of the market yet. But the change in credit markets have been appropriate. Buying in crude oil is really helping things on the downside. But we look back to 1973, a good bull market concluded with a lot of enthusiasm at the turn of the year. I think it was January the 11th. And then a bear market would have followed. But what you had with then, right, and I just looked it up, right at the end of January in 1973 is when the first convictions on the Watergate scandal were done. And so that's then when it really became nasty. But the whole Watergate thing really was an attempt by the deep state, we didn't call it that then, to depose a president they didn't like. And that was the tool. So it made what would have been a bear market worse, and it ended up being the worst bear market since the 1930s, by the time it ended in 1974. Then another one I recall is when Bill Clinton had won the election in 1992. You could see the market knew that he was winning, And he was presenting his campaign as quote, new Democrat, middle of the road. And I, at the time, figured he was running middle of the road, campaigning middle, so to win the election and then govern left. But the bond market was very quick to get onto that. All the scandal stories, which had been repressed by the media, it was the bond desk that got it. All these dreadful scandals came out. So the bond market got marked down right to the election, of course, then it was discounted. Then another one I recall is the end of the bear market in 2008. And of course it was Obama had won that election, and with all kinds of wonderful stories and all that sort of stuff. But the market came down into that October very hard. Our technical stuff came in. It had downside capitulations and everything, and we got a very good bounce out of it into January. But by that time, then, the street was beginning to figure out that this guy Obama was more than just his teleprompter. He had baggage. And the baggage was that he was an acolyte of Alinsky's rules for radicals, and he was out to destroy the middle class in the U.S. economy. So then you had the rebound, and then you had a hard decline into March. But that was mainly in the U.S. The other world markets had set their lows in a washout way in that October, November, and bounced, but did not make new lows. So this was a domestic situation there. So what we have now in the U.S. is a market going down for the usual reasons, over speculation early in the year, a booming economy. You've also had speculation in the financial markets that pushed the yield curve too far one way, and it comes back. Then also credit spreads narrowed too much, and they're going the other way. So you have a declining market on very good timing into the fall of the year, with the usual changes towards weaker industrial commodities, and also the changes in the credit markets, all of which we've been discussing. But now you have a change in the political matrix in the U.S., where the Democrats who have been obstructionists are now have the majority in the House. But as I said, they won't be able to immediately affect the reform that's going on or undo what has been done so far. But they are certainly going to be hell on wheels with an intrusion in every aspect of governance. But with the improvement and the increase in number of seats in the Senate for the Republicans is a very big plus. This will mean they can hold on to the drive to reform government on the judiciary side by appointing straight-up constitutional judges wherever they can. So there's construction there. But in the meantime, it is, and Trump has come down hard. He's just said, okay, you're going to throw it at me, I'll throw it right back at you, because if he gets control of the Justice Department and getting rid of Sessions is a step towards more professionalism in the Justice Department, and then you can sort of clean some house at the FBI so that the real serious crimes in high places can be attended to, and we know those are Clinton's and Comey and various other people. So it is going to be nasty warfare. So let's put it this way, Jim. It's not going to cause a bear market, but it will probably make a bear market worse.
We'll have more with Bob Hoye when This Week in Money returns.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Bob Hoye. Bob, Nancy Pelosi, the chair of the Democratic caucus and now the House leader, says in some cases she agrees with Donald Trump imposing tariffs. Is that a scary moment, or is this an enlightened move?
Oh, Pelosi's the wicked witch from the West, I'll tell you that, from California. Our theme on Trump has been trying to reduce the tariffs against the U.S. and get more of a fair playing field, and that's been fine. But what the other part of this is on tariffs is that if we do go into a recession, which seems inevitable, then with the slowing down of the economy and increasing unemployment and hardship with people laid off, that kind of stuff, then each domestic political system has to look after itself, and typically they turn to tariffs. And the 1825 bubble, the contraction, once it was over, came in severe, and the U.S. passed the what was called at the time the Tariff of Abominations, which was serious. And then, in the 1893, in there with the recession and bear market, the game became tariffs, and the McKinley tariff came in, and that was serious. So then the 1930s, you had the Smoot-Hawley. That was terrible stuff. So the noise for the last couple of years in the system is about tariffs was Trump trying to make a more even playing field. And then now, if we go into discover next year a recession, then unfortunately the tariffs will be severe and the contraction will be severe. And I think there's nothing anybody can do about it. It happens. You have high unemployment in a country, and the economists will whisper in the ear of the politicians, say, well, we can help by doing this. And unfortunately it happens. So I think you can't call it starting right now, but it is a threat in the future. Serious tariffs everywhere. So I hate to say it, but it seems probable. So we would watch for that. Now, on our work historically, with the excesses reached earlier in the year, and the tradition of having a liquidity problem, suddenly discovered in October, as I said, it's been mild so far. But what we looked at is the worst would be coming down into late October. On our technical work on October 26th, on the S&P, we got a downside capitulation, which is a fairly severe reading, from which one would expect a bounce, from which we have had. And then the other part of this was that in November, on previous post-bubble contractions, the worst part would be in October, then a slight bounce, and then in November, the kind of like the ragtag of problems, the last of the offside speculators would be forced out. And I think this is happening here. The decline in crude oil is becoming impressive here now. It has been a very severe drop. And actually, when you remember in August, we were talking about crude oil, and it was staying firmer. And then I thought maybe it's going back into a seasonal pattern that it would do quite a while ago, whereby you could have a high for crude oil in late September or early October, and I think the high was October the 3rd, and boom, down it's come. So that's seasonal. Now, the other part of the seasonal we're working on is that crude can have a dismal low in December or January. But right now, the selling pressures are so relentless, you think, oh, it's got to have a bounce in here somewhere, and it will, but this is now the kind of pressures you know in a day or so. Maybe next week this thing could pause in its decline, but then you've got seasonal lows possible late December, early January. So I certainly wouldn't play the sector from the long side at all. So.
Also, the U.S. reimposed sanctions on Iran, but then gave 8 exemptions for oil exports, and they were China, India, Japan, the world's biggest oil importers. So really, the sanctions when it came to oil didn't have much of an impact, did they?
No, I guess not. Also, there would have been a fair amount of leakage out of Iran. I can agree with the sanctions on Iran because there's a lot of reasonable people live there, and a lot of them may be getting tired of living under a radical priesthood, and you want to help them. The ordinary people get pissed off enough to overthrow an authoritarian government. It's happening in other countries, a move towards more independence on the individual and less centralism and coercion on the part of government. So there's another place where you could have an uprising too, and that's in Venezuela, which is an excellent lesson in only 25 years of how to destroy a country through central planning. And that one must be getting close to pushing off an uprising where finally everybody says enough and throw the scoundrels out. Now that's a polite word, isn't it?
Well,
so
Bob,
anyways,
I was going to say that
fascinating times.
Yes, Venezuela is in such dire straits right now. The country can't afford to print more money. They can't afford the paper to put the money on, you know?
I remember reading one decades ago in Spain in the 1500s when most of the bullion from the New World was being landed at the port of Seville. And, of course, Spain, being authoritarian, was very good at keeping track of the accounts, and the growth in gold was extraordinary. And, of course, they were coining it into sound coinage. But then the ambition of the Spanish government was without limit, which needs funds without limit. So they then went to borrowing money and also depreciating the coinage. And one of the problems they had for a moment was that they were a shortage of copper and couldn't debase the currency, the gold currency. So, you know, strange stories happen when you get into policy. But it was the same thing as we've seen in the last 100 years. The most fabulous creation of wealth through business innovations and scientific advances and engineering advances, the greatest prosperity in history. And for many politicians, it isn't enough. And for many of them, they get greedy and they want it, particularly on the bureaucratic side. So you've had this massive intrusion of in-your-face and in-your-wallet government, and the folks are just saying enough of it. But what the 1500s showed was that the most massive conquest of wealth in the form of silver and gold bullion from the New World was not enough to fund unlimited ambition, and they had to go to borrowing money and also depreciating the currency in an unlimited fashion. And this, of course, is what's been on for the last 100 years in the Western world and elsewhere. So I think that this political reform is well underway, and it's against intrusive government. And what can happen with a contraction here is the public's going to take a look at their accounts each month, and then they're going to take a look at all of the trillions of dollars of tax dollars that were spent by central bankers in attempting to prevent bad things from happening. So there's going to be a universal condemnation of intrusive central banking, and I welcome it. This would be definitely part of a great reform movement to lesser government and less intrusion. And I like the phrase, in your wallet and in your face government. People are about had enough of it. So we live in very exciting times, Jim.
We'll have more with Bob Hoye when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking with Bob Hoye. Bob, we've looked at historical bubbles and bursts. I guess tulips, the most famous example in history. But right now we have cryptocurrencies and marijuana stocks. Are they also examples of things that can boom and bust rather quickly?
Oh, yeah. Well, we saw that with the Bitcoin phenomenon, which had price gains that were exceptional, but what could be monitored in that was a momentum figure. So, gosh, that goes back to December 15th last, when the Bitcoin itself gave us the sequential sell signal. And we noted at the time that this speculation seemed to be destined to peak out in that December, January, and then you got the technical signal. So that was the strongest sequential sell in 2 years. So we figured that the sell-off would be in the order of the greatest in 2 years. And also, Jim, there was a probability that that would be the ultimate peak for that bubble. And then, of course, then you started up or continued the fascination with the marijuana stocks, which has been a fabulous sector, and it shows the same tendency. If you got the right technical tools, you can at least call the swings when they get excessive on the upside or excessive on the low side. But somewhere in here, now also the other one, it gave a tremendous example of the news. October 17th, everything was going to be legal somewhere, and that was the high day. So if we are in a contraction, and at this point it seems probable, then even the latest speculative darlings will fall out of favor. So you got to go back to Radio Corp of America in 1929. That was the big high-tech stock, and they had movies, and they had phonographs, and they had records and everything. And it blew up, and that was in 1929, and I think it took until about 1955 before it got back to the original high price. And their earnings, I remember looking that one up, maybe the earnings for 29 was, let's say, $3 a share. But it took until 1956 or 57 to get back to that $3 a share earnings. And the big earnings was based upon the Elvis Presley recordings. So who in 1929, who was eager for the stock at incredible prices could ever figure that it would take 20 plus years to get back on side, at least just with the earnings, and it was based on Presley. So financial markets provide some very interesting stories.
Bill Morneau, the finance minister of Canada, will have his fiscal update November 21st. What does he have to do to keep Canada competitive with the U.S., where GDP projections for the year at least are around 3%, Canada 1.8%?
You need to have a political reform in Canada. With the Trudeau government, they've gone back to 1968 socialist policies, and they're allowing too many radicals to be influential. Can't build a pipeline. Price of oil is Canada's $50 a barrel lower than in the U.S., so that's impairing tax revenues, and all because you've got radicals in preventing proper expansion of pipelines on the West Coast, and you also have them preventing expansion on the East Coast, such that, you know, they're very concerned about tankers on the pristine oceans of the Atlantic, but they're quite content to have crude oil coming from Russia and from Venezuela to East Coast refineries, but won't allow crude oil from Alberta to go to central Canada, Ontario and Quebec, and the refineries there. It's absolute madness. So there's nothing that this government, the federal government now, can do to improve, because it's not within their policy mix. They are intruders, and the more they remain in office, the more they will intrude. But of course, there's an election, I think, in October next year, so I'm quite convinced that the Conservatives will win, and another dreadful Liberal government will go. So as to policy mix, I don't look for anything sensible from them at all, unfortunately. So the loss of prosperity, you can never get it back. I mean, just even on the tax revenue side of exporting more energy into a world that needs energy, it's regrettable. You can never get it back. It's like how they held up a gas pipeline from the far north for 30 years until gas markets changed, and then there was no point building it. But anyways, I would say, Jim, the policy measures from Ottawa will be hopeless to disturbing. So, and that there's nothing we can do about it.
Bob, could you see Trudeau's imposition of carbon taxes on provinces that don't want them? Could that be the key issue in the next federal election?
Oh, yeah, good one, Jim. Yeah, carbon tax. What you want to do is just take the carbon out, because it's a tax. But they're using the carbon as a means to sell in brutal taxation and messing around with the markets. And also, you know, remember, I took a degree in geophysics years ago and kept up to date on matters climate. And on the science side, there is no proof that increasing atmospheric carbon dioxide forces increasing temperatures. There's no formula that proves it. And then if you take a look at the millions of years of history where you have a record approximating the temperature history, and you also have a record of carbon dioxide in the atmosphere, and when you take a turn to warming, temperature starts going up for natural reasons. About 600 to 800 years later, the amount of CO2 in the air goes up. So on a causal basis, it doesn't even, so it's no theory, and there's no evidence. And as a matter of fact, temperature causes changes in CO2. So then to use this carbon as a means for taxing. It's more scheming, and the only reason why you have this theory about carbon dioxide and climate being promoted so strongly is because it's a theory that puts more power and more revenues into the hands of the state. It's pure socialism, Marxism, whatever you want to call it. And now people at the United Nations are getting even more open about it. They say the only way you can cure the problem is by going to a fully command economy like the Soviet Union or Russia or China before they had their reform. So it's a very old theory that central planning can make all well is just a new decoration or a new banner, this business about carbon and carbon dioxide. And I think that the public is figuring it out. On the midterm elections in the U.S., there were about 4 major climate things that the Greens were all in favor of, and 3 were turned down. So the expected green wave didn't appear. So I think the public's getting smarter about these things, and once they realize that it is just another tax, and that the banner for pushing the tax is utter nonsense, that people can understand that. Maybe a cold winter might help. So there we are.
Bob, my question about carbon taxes is, we know climate change is usually caused by a little change in the Earth's orbit, the tilt of the Earth, sunspots, volcanic activity, asteroid hits. I see in no way how a carbon tax can prevent a volcanic eruption. Pinatubo in one day erased 10 years of carbon credits. So, how do you affect natural phenomena with a tax?
You can't. Well, the carbon originally came from rocks and, into the air and in the form of carbon dioxide. And then way back billions of years ago, these little critters arrived, little bacteria, viruses, and then eventually single cells and algae. And they then discovered photosynthesis, where you took energy from the sun and then converted carbon dioxide, of which it was a whole lot of carbon dioxide in the atmosphere, converted it to glucose, which is the basis of food, and it converted it to oxygen. So without that carbon dioxide and without that sunshine, you wouldn't have photosynthesis, and without that, you wouldn't have food, and you wouldn't have oxygen. And actually, as a geologist, you look back at at even 400 parts per million CO2, it's on the low side. It wasn't so long ago, 300,000 years ago, or a few million years ago, that it was up to 5,000 parts per million, and most of the plant life that exists on Earth today got their start when CO2 was at 5,000 parts per million. And if it gets down to, I think the number's around 140 parts per million, the whole food system for the planet starts to shut down. So the risk in trying to reduce CO2 in the air is to risk ending life on the planet as we know it. But then when authoritarians get going on a perfection idea, there's no stopping them until they burn themselves out. So remember, the communists, they were out to create the perfect man. And after murdering 100 million of them, they were persuaded to give up on the idea of creating a perfect man. And then also the Nazis in the 1930s, they were out to create the perfect race and the perfect land space. And now the authoritarians today are out to create the perfect climate. Scares the hell out of me, Jim.
Well, Bob, perfection. Always a fun thing to strive for, I think, but scary in how you might want to do it.
Right, indeed.
Bob, thank you so much for being on This Week in Money.
Good to be with you, and let's look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He was speaking to us from Vancouver. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Hilliard MacBeth, and Bob Hoye. And thank you for listening. If you have any questions for our guests or for the show, you can send them to info@howestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Larry, welcome back.
Well, Jim, it's not a pleasant day in the market, but I'm in a good mood.
Well, you came back from the New Orleans Investment Conference in a pretty optimistic mood, and you had another announcement as well. So, first of all, coming back from the Big Easy, what did you find out?
Well, it's a totally different show. Everybody pays $1,000 just to go to the show and listen to the speakers. We had interest at our booth. As a matter of fact, we have orders for some of our private placement from that show. So I'm happy. Certainly we know that the show was worth it. And, it's getting to be a more enthusiastic market out there.
And you just announced a big private placement. What's the story there?
Well, as you know, we're working on our technology, and certainly one of the biggest things that we've had to spend a lot of money and a lot of time on in the recent months is a way of disassembling or making the scrap material, which comes glued to foil material, to aluminum foil, and that is something that has to be addressed if you're going to do this on a continuous basis. And we have addressed that, and we've done a lot of testing in that area, and we will be applying for a patent to do that, so that's been successful. The patent could be issued at any time. I have no control over that. And the original patent, and we'll be filing the other patent when time permits. So, it's been a good year. It's been 27 months since we did our proof of concept. So, for the amount of work that we've done and the amount of intelligence we've gathered, we've done a pretty good job. So, we need more money. Certainly, work on the foils took a lot of extra money and time. We still got a good position in cash, but it doesn't hurt to have the markets don't seem to want to cooperate in any way. So we'd sooner raise the money, and at this point, even though today's an ugly day out there, and that goes for not just the markets, but, for metals, precious metals, everything is being hit today. That just shows you that there's a lot of predator trading going on. And but that will pass here. Maybe Monday will be a better day. And but we're happy with our results so far. We feel that we've accomplished a lot in that 27-month period. And with that new IP, when that's filed, that will, IPs are very important to new technologies. And the method of actually dissolving the glues and actually getting them out of the way so that the cathode material can go into our hydrometallurgical circuit. Now we have the complete design of the circuit. We have, it's ready to be built. Most of the parts, I would say 95% of the parts. There's a couple of long lead items that are still waiting. I know people don't like to hear that, but there's nothing I can do about that. And, these had to be fabricated, and so here we are. And we got all kinds of good news out there in the market. With Katango shutting down its cobalt production because of uranium and the cobalt, that's 34,000 tons that won't hit the market next year. And as a matter of fact, Katango is no longer supplying the market. So, as Glencore says, that they can see the price of cobalt going up by 30% in 2019, and I'd have to agree with that. So Katango provided 6,500 tons after their startup right up to this third quarter, and now, like I just said, there's 34,000 tons that won't be hitting the market next year. So the other thing that really excites me is that there's a lot of talk about recycling now, and there hasn't been in the past, but they're talking a number of 21 billion in recycling lithium-ion batteries by 2025. That's a big number. It's not million, it's billion. And you may recall we did a calculation on 100,000 811 nickel manganese cobalt batteries that were valued at about 340 million. I don't think that's really taking place. We've had all kinds of other information out there, other intelligence that said there was no money in recycling, but that whole idea is shifting. And we're getting more and more meetings. Something's going to break in that regard pretty soon. So, we've got good interest in the placement. So, we're just going to motor on. We have to plan ahead, so that's why we're doing the placement now.
Larry, for people who are new to the broadcast, can you give us a little bit of a background for American Manganese? American Manganese is a critical metals company that has a mining deposit in Arizona. We've developed a process for that the U.S. Bureau of Mines worked on and failed for over 80 years. And with Chemetco, who's, as far as I'm concerned, is the best research firm in the world, second largest in Canada, is coming through with stunning results. We got 2 intellectual properties, 2 patents, one pending and another one to be filed. And that was taken off of that sounded like I was talking about the manganese project. I'm talking about the recycling project in which we borrowed the technology from the manganese to develop that. And so we're focusing on the recycling of lithium-ion batteries. As you heard previously, it's a very lucrative area to be in. We feel that we are leaders in that, and we get 100% of the cathode materials back. And by the way, we're going to turn our focus over to the graphite here pretty soon. But currently, with working with scraps, we don't have scrap graphite material. So everything's moving along, Jim. And anybody that wants to read up on, keep current on our news and our business plans and everything else, you can go to our website at AmericanManganeseInc.com. And you can reach the company at 778-574-4444.
You can email me at LREAUGH@AMYMN.com, and you can get in contact with the company.
Larry, thanks a lot.
Okay, Tim, thank you.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on November 9th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.